Let's go into Unit 5, which covers investment income and expenses. Investment income. Now, investment income can come from a variety of different sources. It's very common for you to see investment income from your clients, even people who have, regular full-time jobs. Most people will have investment income coming in from other sources. Even people who don't regularly invest will typically have, a little bit of bank interest, or maybe they own a little bit of stock and it's paying dividends, that sort of thing. So this is very common for you to see, okay? Taxpayers who deposit cash or invest in securities, such as stocks, bonds, and mutual funds, may earn income from interest, dividends, and capital appreciation. So what we're going to talk about in this webinar are when you hold on to an investment and you don't sell it. Now, other types of income from investments, such as capital gains resulting from sales, are covered later. Now, there's a lot of rules that come with selling capital assets, which is why that's considered a separate webinar, okay? That's capital gains from sales. That's when you sell stock or sell cryptocurrency or sell even something like a vacation home or your main home. When you sell, when you dispose of a capital asset, that's when you get capital gains and losses. When you have investment income, like a revenue stream from investments that you own, usually that's something like interest, dividends that you earn off of an investment that you've purchased and you're keeping it. Now, interest income. Interest is a form of income that may be earned from deposits such as in bank and money market accounts, notes receivable, and investments in instruments such as bonds. Some interest income is taxable and some is not. And it's common for the IRS to test you on the taxability of municipal bonds. Muni bond interest, which is interest that's earned from bonds from a municipal source, like for example, if you have a county or a city or, a state even that wants to build something like a light rail or a bridge or a stadium sometimes, they will issue municipal bonds. And if you purchase those bonds, then the interest that you earn off of those bonds is not taxable interest at the federal level. You still have to report municipal bond interest on your tax return, but it's not taxable. But it is considered a type of interest income. Now, certain distributions commonly referred to as dividends are actually reported as taxable interest. These include dividends, in quotes, on deposits or share accounts in cooperative banks, credit unions, domestic savings and loan associations, and mutual savings banks. I used to have an account with a credit union when I lived in California. I don't anymore, but I used to have an account with a credit union called Golden One in California. And when you have an account with a credit union, they pay you what they call dividends. So the laws for credit unions are different because credit unions are not like banks. They're exempt entities, actually. They're not charities, but they're a type of exempt entity that's owned by its members. Okay, so the rules are different for credit unions, but that's why when you have dividends issued by a credit union, it's actually reported as interest on your tax return. They're not reported as dividends. Okay, even though the credit union will call them dividends, that's not how the IRS treats them. So if you have an account with a credit union, or like one of these others here that's listed, domestic savings and loan association, that sort of thing, then the dividends that you receive from them are actually taxed as interest. Okay. Now, interest income is generally reported to the taxpayer on Form 1099 INT. If you've been in this business any length of time, you've seen one of these, right? If it's interest, it's a 1099 INT. If it's dividends, it's a 1099 DIV. They're different forms, okay? And interest income is not the same as dividend income, okay? Interest income is something that you earn off of deposits, and dividend income is something that you earn usually off of stock. The threshold for where a bank has to actually issue a 1099 INT is only $10. So if you earn $10 or more in interest from your bank deposits or from a CD, the bank will send you a 1099 INT. But any amount of interest that you actually do receive is taxable. I mean, it's hard to keep track of, maybe like $3 or $4 in interest. But the IRS position is that if you earn it, you have to report it on the tax return. Okay, so any amount of interest is taxable, but the bank will not issue a 1099 unless it's $10 or more. So it's a really low threshold, but sometimes if you have people who don't have very much money in the bank, they'll actually earn like $2, $3, $4 of interest. And generally the bank will not issue a 1099 for that small amount. Now, if taxable interest income exceeds $1,500, the taxpayer must report the interest on Schedule B, interest and ordinary dividends. Now, I want you to understand this for the test, because on old exams, on the prior exams that the IRS has released, they've asked about when the filing threshold is for a Schedule B. Okay, so if you earn less than $1,500 in interest income, you don't have to actually attach a Schedule B. And most of you are working with software, right? You're not filing tax returns by hand. So you might not even notice when this actually gets triggered by your software, but it's $1,500. So if you have $1,500 of interest or $1,500 in dividends, then your software will automatically generate a Schedule B. And you have to report the interest and dividends on the Schedule B. And then it'll have, if you just look at the Schedule B with the tax return, maybe that you've done for someone who had more than this amount, just look and you'll see that all of the banks or the companies that have issued the dividends, if it's dividends, will be listed on there, will be listed on the Schedule B. So $1,500 in interest will trigger it, $1,500 in dividends will trigger it. And then the last thing that will force the filing of a Schedule B is if the taxpayer has a foreign financial account and they've answered yes to the question in Part 3 of Schedule B. Okay. And at that point, there is no amount of interest in dividends. The taxpayer can have zero interest in dividends, and you still have to file a Schedule B in order to answer that question. That's in Part 3. And we're going to talk about that in the FBAR chapter, which is later. But just remember this filing threshold for the Schedule B. It's $1,500. And then after that, you can't report it on just the Form 1040 anymore. If it's under this amount, then it just gets reported on page 1 of the Form 1040. It's just a number, like a lump sum on the page 1, regardless of how many banks are paying you interest. Like if you get $5 from Wells Fargo and then $10 from Bank of America and then another $5 from someone else, from some other bank, the Schedule B will not be generated by your software. But once it gets to $1,500, then the Schedule B will be generated and all of the banks will be listed on the Schedule B. Bank gifts and rebates. Okay. Gift for opening a bank account. So this is in all the pubs. I don't know why the IRS still makes a big deal about this, but it used to be in the olden days, like in the 80s. If you went into a bank, they would give you a gift, like a non-cash gift, like a toaster, really, or you could pick out like a toaster or a blender or some other household appliance. And I actually found one of these ads it's from really 1980 for a bank that went belly up. And the bank failed. And at that point, this was the 80s. So at that point, the banks were paying crazy interest rates, like 15% on a CD. That was how the 80s was. But you could pick out a gift. So the IRS, for some reason, still thinks that banks are like giving out gifts willy-nilly. So if you receive a non-cash gift or services for making deposits or opening an account in a banking institution, the value of the gift may have to be reported as interest. So if you do find some random bank that's still giving out toasters when you go and open a bank account, you have to report that gift as interest. The value of the gift is determined by the cost of the gift or service to the financial institution. I think I remember just when I was still living in California, I went to go open up a bank account with Chase, and the gift that they gave me was like one of those little solar calculators that's worth like less than $1. And I never got like a 1099 for that gift. Maybe if it's less than $1 for some dollar store calculator, they don't have to issue you anything. But it used to be in the past that you would go into the bank and they would give you some nice like gift. They don't do that anymore, but it's still in the pubs. So if you get a gift for opening a bank account, then you might get a 1099 for the value of the gift. and you have to report that gift at its fair market value on your tax return as interest if you get a gift for opening your bank account, if you get a toaster. Okay, but banks used to give out toasters, and if you Google it, like my bank gave me a toaster, or banks used to give out toasters. There's tons of articles out there about it. That banks used to give out toasters. Okay, number 2, a cash bonus for opening a new checking account or credit card account is also taxable interest. However, rewards earned on credit and debit card purchases are generally not taxable income. Most major airlines also offer frequent flyer programs under which passengers accumulate miles for each flight. And I've been asked this question before. There's a footnote in your book. I don't think that the IRS is going to ask you about this, but if you get points off of purchases for your credit card or frequent flyer miles that you use for trips, those are not taxable. The value of those points are not taxable. And the IRS has issued guidance about that in the past. And there's a few PLRs floating out there when businesses in the past have asked, if we have employees traveling for business, if their frequent flyer miles that they get from like their Southwest accounts would be considered a taxable fringe. And the IRS's answer is no. Okay. So if you actually get cash for opening up a new checking or credit card account, then that's taxable. But I don't know of any banks or credit cards that do that. They give you points, right? I mean, any credit card that I've opened up in the last 10 years, we've gotten points rather than any kind of a cash bonus. So the points would not be taxable, or frequent flyer miles would not be taxable. But if they actually give you cash, then that would be taxable. The IRS generally views rewards as rebates and not taxable income. This is true for customer loyalty programs like grocery store discount cards, punch cards that provide a price reduction after a number of purchases, like those cards that you get, like you buy 10 coffees, you get 1 free coffee at the end, like that, and discounts for opening up a store credit card. Example, Harry applies for a new credit card through Express Airlines Visa. The card company offers 20,000 frequent flyer miles for spending $10,000 in the first 6 months. Harry makes over $10,000 in purchases between February and May and receives 20,000 bonus miles. The value of the bonus miles are not taxable to Harry. And this is true even if he uses those bonus miles to go on like a personal vacation. That's fine. Number 2, Kiana earns $26,000 in wages during the year. She also earns some interest from her 2 savings accounts. So she has savings deposits in 2 different banks. During the year, Kiana earns $9 in interest from the first savings account and $8 in interest from the second account. Because the amounts are below the reporting threshold, she does not receive a Form 1099 INT from either bank. It's under $10 for both of them. However, the interest is still taxable and must be reported on her tax return. She can report the interest directly on her Form 1040. She does not have to file a Schedule B since the amount of the interest is less than $1,500. And this is true sometimes where you have someone who makes a personal loan to someone else and they're earning interest off of that personal loan. Like if people are lending money and they're not in the business of lending, right? So this is like, I'm lending money to an acquaintance or a friend or whatever, but I want to earn interest off that money, and we like fill out like a little loan document. That interest would be taxable too. Even if I don't get like a 1099 from that person, I would have to report it on my tax return. Tax exempt interest. Interest earned on debt obligations of state and local governments, which is commonly called muni bonds or municipal bonds, is generally exempt from federal income tax. So it's exempt at the federal level, even though you have to report it on the tax return. It's not going to be taxable, but it can be subject to income tax by state and local governments. So sometimes it'll still be taxable at the state level, but it won't be taxable at the federal level. Also, even if interest on an obligation is non-taxable, the taxpayer may need to report a capital gain or loss when the investment is later sold. The taxpayer's Form 1099 INT may include both taxable and tax-exempt interest. Tax-exempt interest must be reported on Form 1040 even though it is not taxable, because it does affect the taxability of Social Security, if you can believe it. Municipal bond interest actually has to be added back in order to figure out the taxability of Social Security. So it can affect the taxpayer's overall tax rate if they are receiving Social Security, tax-exempt interest. Now, if a taxpayer borrows money to buy investments that generate tax-free income, that interest is not deductible as investment interest. So investment interest expense is still deductible even under the Tax Cuts and Jobs Act. Most other investment expenses were done away with by the Tax Cuts and Jobs Act, but investment interest expense is still deductible. The only exception to that rule is if you actually borrow money in order to buy something like municipal bonds, then the interest that you pay to actually generate tax-exempt interest from your purchase of municipal bonds would not be deductible as investment interest. And I think you need to remember that for the test. If it's investment interest that you are paying on a loan, but you use that loan to actually buy municipal bonds, then you can't deduct that interest anywhere. Example, Thomas is a software programmer who earns $109,000 in wages during the year. He also received $2,950 in municipal bond interest. The bond interest was reported to him on Form 1099 Int. Thomas must report his wages as well as the full amount of the bond interest on his tax return, but the interest is not taxable. Now, this is what the Form 1099 Int looks like now. You can see it doesn't have a year printed in the corner anymore. The IRS has made this a continuous form now. So the year will be printed right here by the software. If you receive regular interest income, it'll be in box 1. That'll just be regular taxable interest that you might earn off of a CD or a bank account. That'll be there. If you have an early withdrawal penalty because you took money out of a CD early, then that'll be in box 2. And we're going to talk about early withdrawal penalties because these are actually deductible as an adjustment to income. So they're kind of a rarity in the law. Interest on U.S. savings bonds and treasury obligations are here. So this is if you buy a federal savings bond. That will be in box 3. But if it's tax-exempt interest, like muni bond interest, it'll be down here in the box for tax-exempt interest. Okay? All right. Dividend income. So dividend income is a distribution of cash, stock, or other property from a corporation or a mutual fund. Generally, dividends are made in cash. Like if you own stock in Microsoft or Tesla or Apple or any of those big corporations, you're a stockholder, and if they issue dividends, they're going to issue them to you in cash. Okay, in general. Part 2, the IRS loves to test on property distributions from corporations, but that's not typical. Usually if you have a dividend from a corporation that you've invested in, like you bought stock in one of those big publicly traded companies that's trading on the NASDAQ or the New York Stock Exchange, you're going to get your dividends in cash or stock dividends, which we're going to talk about. But generally, if they're going to give you dividends, it's going to be cash. The payor will generally use Form 1099 Div to report dividend income to taxpayers. If a taxpayer does not receive Form 1099 Div from a payor, the taxpayer must still report all the taxable dividend income. And if they are receiving dividends from a big company, like a publicly traded company, then they're going to get a 1099 Div from that company. The only time where you might not get a 1099 from a payer of dividends is when you have some little company, a small company, where it's owned by like 10 people and they don't bother to issue the 1099 Div. Okay. But if you own stock in like Ford or Tesla or one of those big companies, then you're going to get a 1099 Div if they give you dividends. Okay. Now, once again, if the taxpayer's total dividend income is more than $1,500, it must be reported on Schedule B. Otherwise, it can be reported directly on the Form 1040, the page 1 of the Form 1040. They only have to attach the Schedule B if it's over $1,500 in dividends. Dividends are not subject to employment taxes. The maximum rate on long-term capital gains and qualified dividends is 20%, regardless of the taxpayer's individual tax bracket. So a corporation, like a C corporation, can issue either qualified dividends or ordinary dividends. If the dividends are ordinary, then those dividends are just going to be taxed at whatever the taxpayer's normal tax rate is. They do not get a beneficial tax treatment if they're ordinary, which is why they call them ordinary. Now, they're not subject to payroll tax. This is unearned income. It's not like wages or self-employment income or tips or commissions or anything like that. This is not earned income. Dividend income is not earned income. It's investment income. So it's not going to be subject to any kind of Social Security or Medicare tax. But it can be ordinary. It can be taxed at ordinary income tax rates. The time when they get a beneficial tax rate is when the dividends are qualified dividends. And then those are taxed at a maximum rate of 20%. So you always want to have qualified dividends if you can get qualified dividends. But obviously, it's not something that you can control as a stockholder, right? You can't call up Apple and say, hey, do me a favor. Don't issue any ordinary dividends to me this year. I want them all to be qualified. That's not how it works. If the corporation issues a dividend to you, you take what they give you, right? Okay. Now, higher income taxpayers may also be subject to the net investment income tax on long-term capital gains and qualified dividends. And we're going to talk about the NIT later in the ACA chapter. So the NIT is how they get you because they can't tax you with employment taxes on dividend income. So they hit you with the NIT once you get above a certain AGI. Example, Aiden is unmarried and earned $590,000 in wages. This puts him in the highest marginal tax bracket at 37%. So this is the scenario where I think it's easiest to understand how these special tax rates work, is when you have someone who's a really high income earner and they have more than $500,000, let's say, in wages or some other type of earned income coming in, and they're getting hit with the highest tax rate, which is 37%. That's a lot to be giving to the government, right? And remember, he's paying payroll tax on this too. So he's going to pay Social Security up until the cap, and then Medicare tax on the whole thing, plus income tax at the highest rate. So his wages are going to be taxed at a really high rate. He's going to owe payroll tax as well as income tax. So a lot of people, when they do get into these higher tax brackets, they really try to get capital gains and qualified dividends, because those are taxed at a maximum of 20%. So Aiden also earned $120,000 in qualified dividends from various investments. Generally, this is a situation where a taxpayer has invested in the stock or mutual funds of various companies, and then they're receiving dividends from those companies as like a passive revenue stream. The dividends will be taxed at 20%, a much lower rate than his marginal ordinary tax rate. His marginal ordinary tax rate is the 37. That's what he's going to pay on his ordinary income, which is his wages. And if he had other types of ordinary income, like rental income is also ordinary, then he'd be paying 37% on that too. He wouldn't owe employment taxes on his rental income because rental income is passive. So he wouldn't owe Social Security and Medicare tax on his rental income, but he's still going to pay 37% in income tax on that income because it's ordinary. But his qualified dividends are not taxed at his ordinary tax rate. They're taxed at a maximum of 20%. So he's going to get a beneficial tax treatment on this full $120,000 on his tax return. Now, he will be subject to the net investment income tax, though, the NIT, on the qualified dividends, because his adjusted gross income is over the threshold amount for the NIT. So he would get hit with the NIT on that. And like I said, we're going to talk about the NIT later. Non-dividend distributions. Distributions that are not paid out of earnings and profits are non-dividend distributions. They are considered a recovery or a return of capital and are therefore generally not taxable. However, the distributions reduce the taxpayer's basis in the stock of the corporation. So non-dividend distributions are not that commonplace. It's a situation where the corporation has not made any money. Let me explain this. The corporation has no earnings and profits. Or they're paying out of money that's not earnings and profits. So this is a non-dividend distribution. It's considered a recovery or a return of capital. So you reduce the basis in your stock when you receive a non-dividend distribution. And the IRS likes to test on these for whatever reason, even though they're not that common. But once you get a non-dividend distribution, you don't report it as taxable income. It reduces the basis that you have in your stock of the company. And then once the basis is reduced to zero, any additional distributions are treated as capital gains and are taxed as such. Now, generally, if a corporation has no earnings and profits, they don't have the money to be distributing cash to people. Corporations that don't make money don't have money to distribute. But if for some reason you have a corporation that is distributing money, but they haven't made any money, then you're supposed to reduce your basis in the stock. And once your basis is reduced to zero, then any excess beyond that is treated as capital gains. Just remember this treatment for the test. If you see non-dividend distributions, that's a trick question. They want you to say that it's taxable, but I mean, it's not. Non-dividend distributions are not taxable until all of your basis in the stock is reduced to zero. And then it would be taxable as capital gains. Usually when you see non-dividend distributions, they're reported on the 1099 div. It's like $1, $2, something like that. And you will see it like typically with mutual funds, mutual fund investments. But they're not typical. Usually don't see high dollar amounts when it's a non-dividend distribution. You just need to remember this treatment for the test, I think. If they ask you about this, just remember that non-dividend distributions are a weirdo. All right. And this is where they're reported on the 1099 div. So if you get a 1099 div and a person has ordinary dividends, they're there, 1A. And then 1B is qualified dividends. And they have two different lines on the Form 1040. On the Form 1040, page 1, qualified dividends get their own little line because they're taxed at a beneficial tax rate, right? So your software has to have a way of distinguishing between the ordinary dividends, which are taxed at whatever the taxpayer's ordinary income tax rate is, and the qualified dividends, which are taxed at a maximum of 20%. Then you have capital gain distributions here, and then the non-dividend distributions would be here, if they do have non-dividend distributions. And like I said, usually when you see this, it's like $1, $2, something like that. They're not taxable. It's not taxable. You're supposed to reduce your basis in the stock when you get non-dividend distributions. Stock dividends and stock distributions. So a stock dividend is a distribution of stock rather than money by a corporation to its own shareholders. A stock dividend is generally not a taxable event and does not affect the shareholder's income in the year of distribution because the stockholder is not actually receiving any money and all the shareholders increase their total number of shares pro rata. What that means is, like if you have 100 shares, let's say you buy 100 shares of Coke. If Coke does a stock split, like a 2-for-1 stock split, where they split their stock, then you started with 100 shares, and if it's a 2-for-1 stock split, you'll end up with 200 shares. They just double the number of the shares that you have. And what happens is you just split your basis over the new number of shares. When a stock dividend is granted, the total basis of the shareholder's stock is not affected, but the basis of the individual shares is adjusted by the inclusion of the newly issued shares. Now, the only time where a stock split or a stock dividend will become taxable is if the shareholder has the option to receive cash instead of stock. And that's true even if they choose the stock instead of the cash. Merely being given that choice, if the stockholders are given a choice to receive cash instead of stock, then the stock dividend is going to be taxable in the year that it's distributed. Most companies don't do this. If they're going to do a stock dividend or a stock split, you'll just get more stock. And they won't give you the option to receive cash because then it becomes a taxable event. And most companies don't want to do that. Example, Pinto Motors Corporation declares a year-end stock dividend. Sharon is a shareholder in Pinto Motors, and prior to the stock dividend, she owns 100 shares. Her basis in the shares is $5,000 or $50 per share. So this is what she paid originally to purchase the 100 shares that she currently owns. Sharon receives a stock dividend of 100 additional shares. After the dividend, Sharon owns 200 shares. Her overall basis in the shares does not change, but her new basis is in each individual share is $25 per share. So her basis per share goes down. It doesn't go up. She has more shares, so the basis is spread over more shares. Her per share basis goes down. And you have to know how to calculate this for the test. There's numerous examples in the book and also in the workbook, but you have to know how to do this math. Okay, after a stock split or a stock dividend, what the basis per share is afterwards. So Sharon does not have any taxable income as a result of the stock dividend, but her basis per share changes. It goes down. Mutual funds. A mutual fund is an investment strategy that allows investors to pool their money to invest in stocks, bonds, and other securities. The combined holdings of stocks, bonds, and other assets the fund owns are known as its portfolio. So you will receive, if you invest in mutual funds, if you get a 1099 div, usually there'll be like something in every box. There'll be some ordinary dividends. There'll be some qualified dividends. There's a little bit in every box when it's a mutual fund because they have a lot of activities going on and a lot of different types of investments. When you invest in a mutual fund, you're not just investing in the stock of one company. It's like a pooled fund with many different types of investments. Now, what you need to remember about mutual funds is that if you receive a capital gain distribution from a mutual fund, those are always treated as long-term, which is contrary to the normal rule for holding period. Usually, in order to get long-term capital gains treatment, you have to hold an investment for at least a year and a day, in general. Not all the time. When it's inherited investments, the rules change. But in general, in order to get long-term capital gain treatment, which is a beneficial tax treatment, you have to hold an investment for at least a year and a day, or a capital asset for at least a year and a day. When it's a mutual fund, that's not the rule. When you receive a capital gain distribution from a mutual fund, that's always long-term, and that's regardless of the actual period that the mutual fund investment is held. So if I bought a mutual fund last week, and I have only held it for a week, and I get capital gain distributions from that mutual fund, they're long-term, regardless of how long I actually held the investment myself. Okay, so these are a weirdo, and you have to remember this for the test. Capital gain distributions are always treated as long-term. Distributions from a mutual fund investing in tax-exempt securities are tax-exempt interest and retain their tax-exempt character for the payee. Declared dividends. Now, this is another odd tax treatment in the law, and this goes contrary to the doctrine of constructive receipt. This is against the normal rule. If you have a mutual fund or a real estate investment trust, this is commonly treated as an REIT. That's how they say it. But if it's a mutual fund or a real estate investment trust, and that fund declares a dividend payable to shareholders in October, November, or December, which is the last quarter of the year, right? They will frequently declare a dividend in the last quarter of the year, but not actually pay it until the following January. Okay? So you're not getting that money in the year that the dividend is actually declared. If they actually declare a dividend in the last quarter of the year, but then they don't pay you into January, then it's taxable in the year that the dividend was declared, not the year that you actually receive it. So you would have to report the dividend as taxable in the year that it was declared. So this is contrary to the normal rule of constructive receipt, and this is just how it is. You'll receive a 1099 div that says that they declared a dividend or they paid out a dividend to you. But it doesn't matter. Even if you get it like in January of the following year, it's taxable in the year that the dividend is declared, if it's a mutual fund or a real estate investment trust. Constructive dividends. Now, constructive dividends are really bad. We talk a lot more about constructive dividends in part 2, because this is when you have a C corporation, and it's usually a C corporation that's small. So this is not a big company. Okay, big companies generally are smart enough not to do anything this stupid. So, but this is a bad thing. Constructive dividends are bad, bad, bad. This is a transaction between a corporation and its shareholders. And in the pubs, they kind of tiptoe around this. They don't tell you what's actually happening. But this is a situation where a corporation gets audited. It's a C corporation and it gets audited. And generally it's a small C corporation. And, you know, the tax court is littered with these cases, especially back when C corporations had a higher tax rate. C corporations used to be taxed, personal service corporations used to be taxed at a flat rate of 35%, which is really high. And then regular C corporations were taxed at a graduated rate, just like individuals were. So corporations that were really profitable, they always looked for ways to reduce the corporation's taxable income. Because remember, a corporation, a C corporation, we're not talking about S corporations now. A C corporation is a taxable entity. It's taxed on its earnings on the Form 1120. Then when the dividends are passed through to the shareholders, they get taxed again. Okay. So what small C corporations try to do many times is they will try to reduce their taxable income down to zero. Now, there's certainly legal ways to reduce a C corporation's income down to zero. You could purchase assets. You could pay more wages. You could do certain things in order to reduce that down to zero. It's less of a problem now, just so you know, it's less of a problem now since the tax cut instituted a flat tax of 21% with C corporations. It made C corporations a lot more attractive than they were before. Because before, C corporations had a graduated tax rate, and personal service corporations, which are like doctors, lawyers, accountants, that sort of thing, those are personal service corporations, engineers, architects. If it was a C corp that offered those kinds of services by licensed professionals generally, then they were going to be taxed at a flat rate of 35% on all of their earnings. So those types of corporations used to try to do whatever they could to reduce their taxable income down to zero on the corporate side. The IRS would sometimes come in and audit that to see if some of those payments were excessive. Okay? Now, if the IRS does come in and audit the C corporation, then that can have very negative consequences for the corporation as well as to the shareholder, which is why we're talking about it here in part 1. Because this is a situation where these dividends become taxable to the shareholder, but not deductible by the corporation. So they are very negative on both sides. They affect the shareholder's Form 1040 if it's an individual human, and they also affect the corporation in a very negative way. Okay? All right, so let me give you an example. Examples of constructive distributions or constructive dividends. This is a type of dividend. It's just a really bad one. This is a type of dividend that you don't want to have. All right? And like I said, this is commonplace with small corporations that try to get a little bit too creative, reducing their taxable income down to zero. All right. So examples of constructive distributions or constructive dividends include payment of personal expenses. If a corporation pays personal expenses on behalf of an employee shareholder, the amounts should be classified as a distribution rather than expenses of a corporation. And this will happen sometimes when you have a shareholder. Usually it's a single shareholder C corporation. And they've incorporated as a C corporation because they know that C corporations have the lowest audit rate, which is true. C corporations are hardly ever audited, and they will form a C corporation, regardless of the fact that C corporations are taxed twice. They will do this in order to reduce their audit risk so that they can get away with murder. And what will happen is the shareholder, like the company president, right? Many times it'll just be a single shareholder C corporation. It's just him. He'll pay like huge salaries, and then he'll be paying his mortgage. He'll be paying for his own car payment out of the corporate bank account. He'll be paying for like his groceries, all this other stuff. He'll be paying for everything out of the corporation's bank account, all these personal expenses, and deducting those somehow as business expenses. And many times they won't get caught. They don't get caught until the corporation actually does go under audit. And then these personal expenses are reclassified as a taxable dividend to the shareholder. Because remember, the corporation is deducting these as expenses to the business, but they're not. This guy is just like running his house payment and his car payments and his kids like soccer teams and all of this stuff. He's running it all out of the corporation as a business expense when they're not. They're personal expenses of the shareholder. So what will happen is the IRS will come in, they'll audit the corporation, they'll treat it as a taxable dividend to the shareholder. So he will have to pay taxes on all of those amounts, and then the corporation doesn't get to deduct it. So it has a huge effect on the corporation's bottom line, and it also has a huge negative impact on the Form 1040 of the shareholder who owns the corporation, who's doing this chicanery, right? It's chicanery. It's shenanigans. Evil shenanigans. It's shenanigans. You're not supposed to do this, but people do this, okay? And this is how it's classified when it happens. Corporation doesn't get to deduct it. And then on the shareholder side, it becomes fully taxable as a dividend to the shareholder. Okay. Unreasonable compensation. If a corporation pays an employee shareholder an unreasonably high salary, considering the services actually performed, the excessive part of the salary may be treated as a distribution. Now, this is less commonly audited and then disallowed. I looked up several examples in the tax court and also the U.S. district courts. For the IRS to actually challenge this, it has to be, let's just say it has to be egregious. Because, I mean, it's easy for you to go out and find examples, at least in the private sector, of C corporations, large corporations paying their presidents and their vice presidents millions of dollars, right? The huge salaries to company presidents. So if you do have someone who, for example, has their own C corporation, they're like a certified public accountant, or they're an engineer, or, you know, anything else. They run some kind of a business that's successful, and they're paying themselves $1 million salary or a $950,000 a year salary in order to reduce the taxable income of the corporation on the corporate side. You know, but they're the one that's doing all the work, and they're working 40 hours a week or 60 hours a week. In general, the IRS is not going to challenge that if the corporation itself is profitable and that shareholder is doing the majority of the work. But I am going to give you an example of when they might challenge it, where we've seen it in the past in the tax court and the U.S. district court. Now, unreasonable rents. If a corporation rents property from a shareholder and the rent is unreasonably higher than the shareholder would charge an unrelated party for the use of that property, the excessive part of the rent may be treated as a distribution. Conversely, if a corporation rents property to a shareholder and the rent is unreasonably low, the discounted portion of the rent could be treated as a distribution as well. And the best example of this that I can give you is that it's generally bad to put real estate in a corporation. Any kind of appreciating asset is bad. You're not supposed to put those into either a C corporation or an S corporation, because when those assets get distributed later, it's treated as a sale, which you don't want. Just trust me on that. So it's advisable to not hold real estate in any kind of a corporation. And if you have a shareholder that does own, for example, an office building that the corporation is doing business out of, it's typical and commonplace for the corporation to be paying rent to the shareholder. And then that's how you get money out of the corporation. And then the rents are taxed on the Schedule E of the shareholder. That's not shady at all. It's very commonplace. And that's completely above board as long as the rents are reasonable. So let's say you own an office building in a downtown area and you are the shareholder employee of your own C corporation and you're running your business, and you have an office building and maybe you have offices in that building that you're renting out to other tenants. Let's say there's 5 offices in the building. You do business out of one office, and then maybe you're renting to other tax professionals or other businesses in the same building. Okay. This is how people get caught is what I'm explaining to you. So you have your own little office and you're renting that office to your own C corporation, which is fine. That's perfectly legal to do. And you rent your office to your C corporation for $5,000 a month. But everybody else in the building pays $1,000 a month. That's unreasonable rents. Your corporation can't pay you more in rents unless for some reason the square footage of your office is 5 times more than theirs. You have to have a reason for why your rent is so much higher than everybody else's. Okay? So it has to be a reasonable rent that the corporation is paying you for the use of your building. Okay? That's also a way that the IRS will come in and audit the corporation, reclassify it. Now, the rents would have been taxable to you anyway as rent. But what ends up happening is if it's reclassified as unreasonable rents, then it becomes non-deductible to the corporation. The corporation has to pay tax on that full amount, and then it's reclassified as a dividend to you, an ordinary dividend, so it's taxable anyway. And then if it was a situation where you were deducting expenses on the Schedule E against those rents, then you don't get to deduct those expenses anymore because the rents were unreasonable, right? It's treated as a dividend, which is a completely different type of income. All right, so you don't want this to happen either. All right. Cancellation of a shareholder's debt. If a corporation cancels a shareholder's debt without repayment by the shareholder, the amount canceled may be treated as a distribution. And we talk more about shareholder loans in part 2. And I also discuss shareholder loans in the crossover videos because the IRS has several released exam questions just in the last few years that deal specifically with shareholder loans. I don't know why they have so many examples in the released exam questions. I mean, they only release 20 exam questions every year, and at least 2 or 3 were specifically about shareholder loans and forgiven debt and that sort of thing to the shareholder. Okay, so cancellation of a shareholder's debt would also be considered a constructive dividend. And then property transfers for less than fair market value. If a corporation transfers or sells property to the shareholder for less than fair market value, the excess may be treated as a distribution. Because remember, as I said, if you distribute property, we're not talking about cash. If you distribute property out of a corporation to a shareholder, and it doesn't matter if it's a C corporation or an S corporation, the tax treatment is going to be the same. It's treated as a sale. A corporation is not a partnership, folks. A partnership is a true pass-through, and corporations are not. A corporation is separate from its shareholders. So when property comes out of a corporation, like for example, a plot of land or a building or some other type of physical asset or intangible asset, even like a patent or something like that, then that's treated as a sale. And it has to be treated as a sale at fair market value. But sometimes corporations will try to do this in a shady way, and they'll try to distribute property at lower than its fair market value because the shareholder wants that property for themselves, and you're not allowed to do that either. And then below market or interest-free loans. So if a corporation gives a loan to a shareholder on an interest-free basis or at a rate below the applicable federal rate, the uncharged interest may be treated as a distribution. And I talk more about this in part 2. There's a de minimis threshold where you don't have to charge interest. It's $10,000. It's a de minimis loan. And it's commonplace. I don't want you to think that this is illegal or anything like that. It's commonplace for a corporation to lend money to the shareholder and vice versa. Like, for example, when a corporation is just starting out, it's their first year, many times they don't have any revenues yet. They don't have money to operate. And the corporation has to have money in order to purchase assets and supplies, paper, pens, that sort of thing, toner for the printers. So the shareholder will lend money to the corporation. You put that on the balance sheet, and then the corporation can pay back the shareholder at a later date. And that's commonplace because most of the time banks are not going to lend money to a corporation that's just starting out. When you have money, they always want to lend you money, right? For those of you who have experience with banks and lending, right? When you're broke, nobody wants to lend you a dime. Or when you're like have a foreclosure or you have like some mess with your credit because of divorce or whatever, nobody wants to lend you money. You can't even get a credit card. And then when you have money Ooh, boy, those credit card offers are like coming in like an avalanche. And then you get all these ads and banks are like, ooh, do you want money? It's like, no, when I needed money, nobody would lend me anything. But now that I have money, I don't need your money. But now everybody wants to lend me cash. But that's how it is, right? You understand that's how it is in real life. So many times you will have a situation where a corporation gets money where a shareholder will lend money to the corporation, and then vice versa, the corporation will lend money to the shareholder back. As long as there's a bona fide business purpose for that to happen, it's okay. But if it's a loan and it exceeds the de minimis loan threshold, which is $10,000, like let's say your corporation lends you $100,000 because you're going to buy a building, right? But you don't want the building to be in the name of the corporation because you don't want a situation where if the building is later distributed, that it's treated as a sale. So the corporation can loan money in order for you to buy a building for the corporation to do business out of. That's a bona fide business purpose. But then in that case, you have to be paying interest on that loan, right? And it's better for you to be paying interest on the loan to your own corporation rather than paying interest to a bank, right? The bank would get that interest rather than your corporation, which is better for them to get that interest. But it has to be a bona fide loan. You have to be making payments, and there has to be interest, and there has to be an interest rate and all of that. Okay? All right. So let me give you an example. Erica's father owns 95% of Spitfire Motorsports, Inc. So the dad is the majority owner of this company. Erica and her siblings own the remaining 5%. And this is a typical scenario, just so you know. It's commonplace for people to have a situation where the parents are the majority owners, or one parent to be a majority owner in a company, and then have the children as minority owners where they will own a very small percentage of the company, or if it's an LLC, for example, they will own like a 1% or 2% of the LLC. Now, I know that sometimes as tax accountants will say, why are you doing this? Because what ends up happening, if it's not a corporation, right? If it's a multi-member LLC and you have a child that has a very small ownership stake, like 1%, then that's going to trigger a partnership tax return, right? If it's a multi-member LLC and it's not a husband and wife or a spousal owned business, if it's a same-sex couple, then that's going to force a partnership filing. But the reason why they do it is because of legal protections. Because if you have an LLC that has even like a minority owner, a 1% minority owner, then it can increase legal protections in some states. It's called charging order protection. Not in every state, but depending on the state, sometimes that will give the business better legal protections if the business is later sued. Okay. Now, Erica performs administrative assistant duties on a part-time basis for the corporation and is paid a salary of $700,000 a year. The corporation also pays for various personal expenses Erica incurs, such as monthly payments on the car she uses to commute to work. So she gets this huge salary, and she also gets a company car. The IRS would likely consider Erica's salary to be unreasonably high based on the nature of her duties, meaning that a portion of the salary and the personal expenses would be reclassified as constructive distributions. So taxable to her and then not deductible by the corporation. If that happens, then the constructive distribution becomes taxable to Erica as a taxable dividend, and the amounts are no longer deductible by the corporation as a business expense. So it has a very negative impact on both sides. And the example that I had before was that she was being paid a salary of, I think, $250,000. I think originally I put $250,000. And Joel Bush, who is the attorney, who's one of our co-authors on the book, he changed it. He said usually the IRS will not challenge this unless it's some obscenely high number, like 500,000 or 700,000. They wouldn't necessarily challenge it if it was like 250 or 100,000, even if it's like a child working for the parent and they're like an administrative assistant making 200,000. Because remember, the IRS on those wages is still getting, payroll tax, and they're still getting income tax on those wages because they're being reported on the individual employee's side. Like Erica would still have to file a tax return and report these wages, right? So the IRS is still getting those taxes. So it takes like a very egregious amount before the IRS will reclassify amounts as unreasonable compensation. And an example of that is a case called Transport Inc. versus Commissioner. And this is an actual case where it was this exact scenario almost, where it was a C corporation owned by the father, and he had 3 sons. And the sons were just working like part-time in the dad's business. And he was paying them like $560,000, $660,000, that sort of thing, over multiple years. And the IRS reclassified a portion of the son's compensation, his children's compensation, as unreasonable, and made it non-deductible to the corporation, which means the corporation would have to pay income tax on that at whatever the corporate income tax rate was, which at that time, when this case was decided, was much higher. So the corporation, the IRS was able to get 35% income tax out of that corporation on those amounts, on those reclassified amounts. So it behooves the IRS to do that when the amounts are really high. Okay. But it takes a lot, according to Joel, and even according to this case, for the IRS to challenge the unreasonable compensation issue, because they're getting tax out of those wages anyway. Okay. That's the end. Unit 6, we cover the basis of assets.